If you've ever thought about using your super to reduce tax, buy property, or take control of your investments, you've probably wondered if a self-managed super fund is right for you.
Australians don't choose superannuation. It's a necessity that's left in the hands of big institutions, and over time, you realise that you have little trust and even less visibility in how your money is being managed.
That's why an SMSF can be one of the smartest financial decisions that you ever make. It offers control of your retirement savings, simply that big funds can't.
Here's the catch. Self-managed super funds aren't for everyone. There's big costs to set them up, ongoing costs, and potential traps and pitfalls.
That's why today we're unpacking what an SMSF is, who it's for, who it can benefit, and the potential downfall and risks associated with setting one up. Jared, welcome back to Your Wealth Playbook. Today we're going to go through all things self-managed super funds, what it is, who it's for, how it can benefit you, and how you actually set them up. What are the costs?
Timely episode with the 18th anniversary of self-managed super funds in Australia this week. And obviously over the last 5 years in particular, huge explosion of people using them, not just business owners, but the average Australian cottoning on to the fact that, yes, it is an amazing way to build wealth. It's also a very tax-friendly way to build wealth.
Long story short, everybody has a superannuation fund. It is legislation with government at the moment that your employer has to pay 12% of your salary into your retirement savings or superannuation in Australia. It's been around since 1992. So everybody has a superannuation. It's usually managed by a retail super fund or an industry super fund. You'll see the ads, the little triangle or whatever they bloody put on the ads, you know, we grow together and compare the pair, all of those things. So everybody has a superannuation fund. A self-managed super fund is that you take it away from those big industries that manage your money and you manage it yourself because you think that you can do a better job.
Now, why would you, as an average Joe, think that you can manage it well yourself?
Jared, the differences between big superannuation funds or industry super funds and a self-managed super fund is exactly that. The big super funds will charge you money in investment fees to go and earn a return on your money. A self-managed super fund does not, because you manage it yourself, or you basically think that you're better than these investment managers. You take your retirement savings and you go and invest it. Yes, there are still costs associated with doing so, and that comes through with annual accounting fees, ASIC fees, audit fees, compliance fees, which you have to do every year. But one thing that a lot of superannuation funds, industry funds don't tell you is that they also charge you investment fees on every dollar that you have invested. It can be hidden in their PDS, but it's a percentage based. It can range anywhere from 0.1% all the way up to 1%.
I think that's a good thing to know as a key difference between the two of them is there's some fixed costs associated with setting up a self-managed super fund versus percentage costs that are with your industry funds. So when you're looking at investing and moving your money over from an industry fund to a self-managed fund, you've obviously got to have a bit there to make it worth your while. If you've got $100,000 and it's going to cost you $7,000 to $10,000 to set this thing up, plus have it audited every year, as a percentage of that fund value, it's not necessarily going to be worth it.
Jared, who is a self-managed super fund for?
So we see most self-managed super funds set up for business owners, and especially for business owners who want to look to acquire their own premises. So it might be a builder who's got a warehouse. Instead of paying rent or a lease to the landlord, they feel that they can go and buy it themselves, put it into their super fund. The rent or the lease that they're paying is going from them straight into their super fund. And they've got an asset that at the end of the day is growing in value.
You're going to move money from your right pocket to your left pocket. So from the business in rent to your super fund at a super low tax rate of 15 cents in the dollar. You get the expense in the business, so you don't pay any tax there. The income goes through in the income for the self-managed super fund, and you take out the expenses. Any profit left over is taxed at 15 cents in the dollar. So it can be a nice way for business owners to accumulate wealth. Who else is it for?
Property investors, specifically ones that want to directly invest into property, whether that's residential or commercial. Now, any profit made on that fund through the derival of rent, while it's through its accumulation phase, will be taxed at 15 cents in the dollar, which is the lowest tax environment in Australia, especially while you're working and earning good money. in your personal name, you'd be paying close to 50 cents in the dollar. Now, after that, when you get into your pension phase, capital gains free on any sales. So if you're selling that property and it's gone up in value from 500,000 to 2 million when you retire, you're not paying a cent of capital gains. If that was held in your personal name at that point in time, probably paying about 500 grand worth of tax on that same transaction.
It can be easy to get a property that you hold personally into a self-managed super fund with the right advice at the right time. One story that I've got with a client of mine that I work with an accountant, they held a commercial property that they'd bought 20 years ago in their personal name. They were in their late 50s, had access to their super as they were retired in a couple of years' time. We moved that property from their personal name into their super fund. The income was about 100 grand a year. We made some contributions into super to reduce that taxable gain because it is a sale of an asset moving from your personal name to the super fund. Once it was inside the super fund though now that they're in pension phase, that $100,000 worth of income is no longer taxable. They get that full $100,000 per year as tax-free income rather than losing $15,000 per year in tax. It's quite a nice game.
Who else is the ideal candidate for a self-managed super fund?
I think we've touched on the two biggest ones being business owners and also property investors. But if you want an asset allocation to alternate assets, now this is not a solicitation to go out and buy these, but I have a lot of people that really like gold, really like silver, really like artwork. I've even seen the 2015 Bathurst winning V8 supercar put into a self-managed super fund because it's a collectible. You can't own that sort of asset anywhere else in an industry fund. You can't go and say, hey, can I go and put the V8 supercar into my industry fund? You can't do that. You obviously can, and there is very strict rules on what type of assets can be in a super fund, but collectibles is one of them. And obviously you've got to go through the rigmarole and audit and everything like that, and you can't use it for personal use. But you may have collectibles, you may be a very high net worth individual, you've got lots of assets, and you're looking for the most tax-friendly environment, then a self-managed super fund ticks those boxes. Why would you have an SMSF?
So the big one is a tax strategy. So when you have a self-managed super fund set up, ideally it is because it's the lowest tax environment in Australia. To be able to benefit from that, not only through the accumulation phase and to be able to move funds outside of your personal wealth into self-managed super fund, but also through the pension phase and the drawdown phase where you can strategically dispose of assets and not pay any capital gains on them or draw an income from them through retirement without paying tax on them.
It's that control aspect that you've got control over your retirement savings. It's not with an industry super fund where you get these black boxes when they say it's in a balanced investment option. Like what's a balanced investment option? Where is my money actually invested? With a self-managed super fund, you can actually see because you've got control over where that money is invested. Not to say that industry super funds don't do a cracking job. They're obviously managing tens of billions of dollars on behalf of Australians. But if you want to take that control and you want to know where your money's managed, and if you think that you've got a cracking idea, if you're a sophisticated investor, then a self-managed super fund might be right for you due to that control aspect.
Like you said, it's being a sophisticated investor. If you are a property investor and you know what you're doing with that money, or you've got the ability to invest into locations or projects that you've been a part of where you feel there's going to be significant upside outside of what you would have got within an industry fund, or the ability to leverage as well, which you don't have within an industry fund. And when I say leverage, I mean the ability to go and purchase an asset that might be $1 million. You'd have 300 grand worth of cash within your fund. The leverage piece is that you can borrow or lend to be able to acquire that asset. And then you've got an asset worth $1 million going up in time, getting a return of, somewhere between 7 and 10% over a period of 20 or 30 years versus that 300 that you're getting the same sort of return on average.
The return on 7 to 10% on $300,000, let's call it $30,000 versus a 10% return on $1 million is $100,000. Last time I checked, 10 was more than 3. So it can expedite your retirement savings. Also, one thing that you touched on there, Jared, is the benefits that you get as a business owner and leveraging. A lot of times, business owners will be putting the majority of their money into their business. If they're not, their wife will be saying, I want a beautiful big family home. So they're probably tapped out in terms of their lending capacity. A separate structure being the self-managed super fund, because it is a separate structure, it has separate income. The banks don't look at your personal financial circumstances, only that fund in isolation. So then it allows you to probably go and purchase your workspace, that you don't have to worry about someone jacking the rent up on you. You don't have to worry about someone selling your business premises underneath your feet. You don't have to worry about renting and paying off someone else's mortgage. You can go and rent back to yourself. But you must meet the sole purpose test if you are a business owner renting the property back from yourself, meaning that it has to be at market rent, because the ATO is not going to like if you say that you're renting your business premises for only $5 a week, because that's not going to stack up. Additionally, you can't say that you're renting it for $1 million a week to try and move profits out of your business to your retirement savings, because the ATO is not getting a clip of that either, so they won't like it. So there's specific tests that you have to meet if you're a business owner. But from a lending point of view, it can really help to have a self-managed super fund if you're a business owner, own that premises due to the lending, because it's a total separate entity, not your personal name.
Spot on. You touched about lending within a self-managed super fund. Now that's a limited recourse borrowing arrangement. And that's something that has been around now for 18 years. This is the anniversary this week, with lenders, specifically tier 2 and non-bank lenders. Tier 1 lenders, Big Four, fell out around 2015 due to capital requirements. But there's some great lenders around in that tier 2 space that do that are specialists when it comes to super fund lending. Now, a lot of them will have higher deposit requirements depending on the assets that you're looking at. But there's other lenders out there that you can still get an SMSF asset purchased and borrowing still up to 90% of the value of the property, or with commercial up to 80-85% depending on the asset type.
It's not too bad. You talked about tier 2 lenders or non-banks, so the Big Four aren't in it anymore. But what's the rates with a tier 2 lender in an SMSF?
So rate-wise, you'll still find them very, very comparable with that of an investment loan, maybe slightly higher depending on the loan to valuation ratio, so how much you're borrowing versus how much the asset is. But you're still looking at rates, starting with low sixes, and for commercial mid sixes, which is not too bad at all. You can still find some old grandfathered arrangements with the Big Four. And what I mean when I say grandfathered is that they've got SMSF loans that have been set up there and that are still running their course. They just don't have any pricing associated with them, and they want to shoo them out the door. So those rates can still, be close to double digits in the current market.
Yeah, yuck. You probably want to have a look at refinancing if you do have one of those and they're trying to get you out the door, that you can get some cracking rates now around the investors, I believe. I'm definitely not a mortgage broker, Jared. That's your domain. But I know that they are a little bit higher because they are tier 2 banks, basically, not the Big Four that are into these self-managed super fund lending.
Now, when looking at the ability to leverage here, also keep in mind with this limited recourse borrowing arrangement is that you have the ability to get into this property right now and borrow for it, but you don't have the ability to draw on the equity. So as a property investor or a property investor listening to this, you might have the experience where you can go, freshen up a kitchen, bathroom, new painting and flooring, get it revalued, take some equity out, go into property number 2, rinse and repeat that model to accumulate a property portfolio. Now, with SMSF lending, you can't do that. That one asset is secured by that one loan. You can't access the equity within it. Essentially, to access the equity within it, you'd have to sell that property, pay the debt off, and take your cash out and split it into purchases at that point.
Jared, does the income that property derives, so let's say I've paid off that loan now for the property that's sitting in there, it's now producing me $50,000 worth of income. Will the bank now consider that I've got $50,000 worth of income to service another loan if I wanted to go and get another property inside my self-managed super fund?
Yep. So you've paid off that property, debt-free, you've accumulated enough for another deposit. The bank will then consider the income that's going in to the fund via the rent of the new property that you're acquiring, and also what's going in via your super guarantee.
Okay, perfect. So can't pull the equity out, but once the income's there, we can use that for serviceability as more income for the next one.
And depending what the trustees want to do, like I said, you've also got the ability to potentially sell that asset off, and it might then be worth it for that leverage play where you can split the equity there, let's call it $500,000, into deposits over 3 separate properties and leverage for each of those ones individually. And also from a lending perspective, if the income doesn't stack up enough within the fund, but outside of your super fund, you've got plenty of earning ability, and you have at the end of every year 70 grand left over in your household budget, and you can prove that in a servicing exercise or a borrowing capacity test. We can actually say that, hey, we've got an extra 70 grand left over here. We're going to put an extra 20 into contributions each year into that fund, and the borrowing capacity will increase based on that.
Yeah, okay. So the income's important when we're looking at borrowing inside a self-managed super fund.
Yep.
But in essence, when we're buying property, you can't redraw on the equity. It's a limited recourse borrowing arrangement. Once we pay them off, we can use the income to then service another loan or to do whatever we want to do. But the rates are going to be a little bit higher because they're Tier 2 banks. The cost of setting up a self-managed super fund aren't cheap. They range from around $4,000 to about $8,000. You will generally need an accountant to help you set them up. An accountant is not a financial advisor, so they can't advise on your retirement savings. So you may also need a financial advisor as well. I know there are products out there that you can go and set up a self-managed super fund online. Would I recommend that you do that? Not unless you are really sophisticated. And if you are a really sophisticated investor, you'll generally have a good accountant anyway. So that would be my first point of call. The ongoing costs as well with the self-managed super fund, because you will have to have and complete financials, or your accountant will have to complete financials each year. It's a bit like your tax return. The self-managed super fund will have to do a tax return. There are compliance costs that you will need a specific SMSF auditor to go through and make sure that all of your self-managed super fund is for the benefits of the retirement of its members. So every investment, every asset, all of the income, it has to be for the benefit of the members and their retirement benefit specifically. So an auditor will go through and just, look at the books, make sure it's there. That is critically important for the ongoing costs because, as we mentioned, the super fund tax rate is 15 cents on the dollar. If your fund is non-compliant because that auditor's picked up that you're doing something that you shouldn't be doing, the tax then goes to 45 cents on the dollar if it's non-compliant. Not a spot that you want to be in, paying additional money in tax because it is non-compliant. So that's where there's specific rules that you have to go and meet each and every year, and it will be audited each and every year.
Now, for people listening, they've heard that if it's non-compliant, it's going to 45 cents. They're freaking out. How does a fund go from being non-compliant at that point in time to being compliant? Is that a matter of there's a list of requisitions that come out that they then have to fix up and it gets re-audited to show that it is then compliant? Yeah, it goes back down?
Yeah, the biggest one that I see all the time with clients SMSFs that aren't audited is because they haven't completed the financials, meaning that there's been no order to go through and complete, the checks and balances of that. So the first point of call will be to go and get the financials completed, get the auditor to go through it. The auditor then send those details to ASIC and to the ATO and say, yep, tick it off. This is a complying super fund. You can complete your financials and away you go. You'll also have tax to be paid each year. So if you haven't fixed up your tax because your contribution's going in, if you haven't paid your tax, naturally it's because you haven't done your financials and you don't know how much tax that you need to pay. So it's a bit of a circle loop here. That's why I say an accountant is very important with a self-managed super fund because that needs to be done every year and you don't want to be in that non-complying 45 cents in the dollar zone.
Now, getting it set up right the first time is critical. Are there any pitfalls that you see around the setting up of the trustee of the super fund?
Jared, it is critical to get it set up properly to start with. That's why I always recommend going and seeing a great accountant to get it set up. Essentially, the biggest piece that you need to get set up is whether it's an individual trustee or it's a corporate trustee. A corporate trustee is a company. The individual trustee is pretty self-explanatory. It's just a member of the fund. Long story short, clients that had a property, had it as individual trustees, it's end up going to cost them to change the individual trustee with a deceased member over $150,000. If they'd have had that as a corporate trustee, it would have literally cost them $15 in 2 minutes with ASIC to change the director of the corporate trustee. A lot less paperwork, a lot easier on the fund to manage the members of the fund when you've got a corporate trustee. Yep, it costs you $660 to register with ASIC, a company, but geez, it saves a lot of headache forever.
Now, it's important to remember that SMSFs are not a one-size-fit-all. They're an absolute game changer when it comes to building wealth, but it also comes with potential pitfalls if you set it up wrong. So it's important that you get this set up right from the start with the right people around you.
One of the key things that I would add to that is that if your superannuation balance is under $300,000, don't even consider it. Especially if you're looking to go in to get into property, the numbers just don't stack up. Much prefer around that $500,000 mark, especially if you're trying to get into a residential property. The numbers really start to stack up from there. Under $300,000, forget it. Put it in the industry fund, get your 10%, grow your balance, don't worry about it.
The fixed costs at that point in time don't outweigh the benefit of having a percentage-based cost in your industry fund based on that size of investment.
All right, that's a wrap on self-managed super funds, Jared. Hopefully the listeners have gained a little bit of knowledge around why set one up, who they're for, and what a self-managed super fund is.
Thanks for tuning in to this week's episode of Your Wealth Playbook, and remember to always look long and play short.
Thanks for tuning in to another episode of Your Wealth Playbook. If you could help us out in any way, the biggest benefit that Jared and I, and also Danny, will get is if you can subscribe to this podcast on your favorite platform and maybe share it. Send it to somebody that will benefit. You'll help us. If you'd like to help us, we'd love for you to help us.
The information in this podcast is general and does not consider your personal objectives, financial situation, or needs. Before making financial decisions, consider whether it is appropriate for you and seek professional advice. Past performance is not a reliable indicator of future results. If you would like to discuss today's topic further, reach out and we would love to help.
Jared and I have not assessed your individual circumstances. Therefore, this podcast is general in nature and for informational purposes only. This is not personal financial advice. There are so many advisors and brokers in Australia. You'll find one that you resonate with, but this is for informational purposes only. Or maybe just use Jared and I.